With all of this, you would have thought there would be some stories of institutional defaults of MFIs. But actually, there have been no defaults, to my knowledge, that have been a direct cause of the crises. There have been defaults, and there have been mergers, and there have been emergency bailouts, but they've been generally caused by other factors that predated the crisis. Now, there have been some threatened runs on banks from MFIs that were swept up in a loss of confidence in the banking system as a whole, but these have been fairly quickly rectified. Because of the strong backing that microfinance institutions have from the public sector and the socially responsible private sector, it would be pretty unlikely that an institution would be allowed to fail. So in addition to underscoring the end goal and the critical importance of building domestic capital markets that would serve microfinance, I think another thing the crisis has clearly underscored is the critical need for client protection and values around consumer protection, responsible lending, transparency in pricing, plain English explanations, etc., and issues around indebtedness. What we see is competition in certain markets and, pressure to grow coming in large part from investors has caused microfinance institutions to expand significantly and has caused increases in borrowing rates by microfinance institutions. So there's a real concern about over-indebtedness in some markets. But, it's not clear where and how, because in some regards, yes, indebtedness is a serious problem, and it could be terrible if a microfinance borrower is borrowing from 5 or 6 institutions or borrowing from one to repay another. That could be terrible. But it also could mean that the products that are being offered by the microfinance institutions either aren't large enough or aren't long enough to meet a micro-entrepreneur's needs. So I think we have to understand much more deeply what's going on the client side, what are their real needs, what are they going to use, what can they handle in terms of debt capacity before we can declare a crisis of indebtedness or before we can declare victory. So really understanding what's going on behind these numbers, behind the multiple borrowings and the saturation in some markets is going to be critical going forward. So I think it's very important in some markets for microfinance to be able to more clearly distinguish itself from mainstream profit maximizing consumer credit in those places where they're competing head to head. Because even if at a values level and an ethical level, we can say that clearly microfinance holds client benefit at its core, whereas consumer lenders don't necessarily, sometimes at an operational level, it's very difficult to tell the difference. And that's something I think we're going to have to do a much better job at. And the crisis leads us to invest more deeply in making that distinction clear. Even though CGAP is not on the ground and is working more at a policy level, there are a couple of things we've been doing to respond to the crisis. First, at the funder and investor level, we did convene a meeting very quickly in London at the end of the year last year to help people understand what one another's responses were going to be and what appropriate responses would be from the funder and investor community. And that, I think, gave rise to some conversations that were useful and perhaps even contributing to some of these liquidity facilities. At the microfinance institution level, we've done some surveys in partnership with some of the networks who were really helpful in this area of about 400 microfinance institutions to really understand the impacts that they were seeing across the board, both at the client level and their own financial performance level, and whether there was a liquidity issue. Some group of investors, we've been trying to monitor very carefully the liquidity needs of the second and third tier microfinance institutions who were cause for some concern, given that most of the liquidity facilities have been targeted at the top tier. And at the policy level, we have some very interesting work that's coming soon, where we're looking at the different policy tools governments have at their disposal to stimulate access and to protect customers in the wake of a crisis, and frankly, at any time. So different tools in terms of market mechanisms, in terms of subsidy, in terms of fiscal incentives, in terms of priority sector lending, or in terms of non-financial interventions like market conduct regulation around consumer protection, for example. So I think it would be really exciting to have a clear understanding about what governments can and can't do to try to react to ensure that access continues to build even in the wake of the crisis. And then at the industry-wide level, again, as I've said, we've done surveys and some regional cuts of the data that we're seeing, and we're about to launch with Citigroup and the Center for Strategic and Financial Innovation in London the second annual Banana Skins report that looks at the risks microfinance is facing, banana skins, that we did this last year as well, and it's very interesting to see that between last year when things were booming and growing fast, the main risks were how to contain the growth and make sure that the whole industry didn't run off the rails. So the risks that were identified as top risks last year were management quality, governance strength, and regulation. And also there were some issues that were cited around risks about there being too much funding. And now it's completely reversed. And what's risen to the top, clearly to the top of the risks, as identified by several hundred respondents, is credit quality and liquidity. Management quality and capacity is still up there in the top grouping, but there's really been a shift in perspective of how do you manage and contain the tremendous growth that's been experienced to looking deeply at the risks it might cause by the crisis. So the question really is, what can donors and investors, whose main instrument is money, generally in hard currency, do to respond to this crisis? It's kind of counterintuitive, because what we really want to be doing is having donors and investors contributing to building a local capital markets, extending yield curves, building swap markets and forward markets so that the domestic market can handle the funding needs, both equity and debt, of microfinance, and helping institutions to mobilize deposits. But it's counterintuitive because the money that the investors have is often hard currency, and it's cross-border, and it's usually debt. That being said, I do think that there are creative ways that donors and investors can help stimulate the shift to deposit-based microfinance, domestically deposit-based institutions, and where that's not possible, at least focus on providing investments in such a way that they might bring in or catalyze domestic investors through back-to-backs or non-deliverable forwards and things like that, and also focusing on where the international investors will really add value over the long run relative to the domestic markets, and that's in longer-term debt and in equity. So I'd hope that we would see more local currency from investors, more equity, more longer-term debt, and in any cases, a real effort to ensure that their money is not in any way crowding out today or in the future the incentive, not just the existence of local investors, but the incentive to develop those local investors and those local deposit markets.